You know me, I'm team supply and demand. But that doesn't mean I completely reject every other trading system out there, especially when we talk about support and resistance. This is an established theory used by millions of traders everywhere in the world on every chart there is. Or is it really a valid trading strategy? Can we become consistently profitable using support and resistance? Is it similar to supply and demand by any chance? Or does it work completely against it? Today, I'm diving into the world's most popular trading strategy and making my case for why I believe it's one of the key reasons traders consistently lose money. Let's talk about support and resistance. Alright, first of all, let's take a look at the default case for support and resistance. Almost everybody trading support and resistance starts with this case because it's the most common one. Here, I'm looking at copper futures on a daily time frame. But you see this everywhere as well. Metals, Forex, stocks, agricultural. It's the same everywhere. But I chose copper because it's one of those cyclical assets that are always ranging between two price areas. So it should be ideal for trading support and resistance, unlike inflationary assets like gold or Bitcoin. Alright, first we need to draw our key levels, starting with the support. So we start from the bottom and try to get as many of these structures touching our support line. Alright, next we draw the resistance line, starting from the top. And we need to have as many swing structures as possible touching this line. Do we have any more lines to draw? I think we do. There's another resistance level just below this one. And look at that. The current price is actually coming back into this resistance zone. That's great news. Now, any trader who knows enough about support and resistance is looking to short from this area. So we place our order, entry at 412, stop at 418, and take profit at 381. This is actually a very good trade. The risk to reward ratio is over 1 to 5. So if we are risking $1,000, we should expect to make $5,000 on this trade. Please keep in mind that we haven't done any supply and demand analysis here. This trade is based on support and resistance analysis. Those of you who know supply and demand already know what's going to happen right now when we move forward in time. So let's do that next. Of course, the price pierced through the resistance level, didn't respect it at all, and our stop loss was triggered. We just lost $1,000. Okay, what went wrong here? Why did we get stopped out? Why is there a massive institutional candle breaking through the resistance like this? That doesn't make any sense. It goes against everything we know about support and resistance. Believe it or not, this is the default case of support and resistance. And this is the main reason why beginner traders lose so much money when they trade support and resistance. They don't understand market mechanics. They don't get what happened at this key level. So in order to explain what went wrong here, we need to use supply and demand terminology. And we need to take a step back and ask ourselves, what are charts? Every price chart is made of a giant grid. Traders want to buy and sell at different price points. So the hidden power that's moving the price up and down is actually hidden behind those horizontal lines, because some of those lines are key levels, and each key level, they are unfilled market orders, dormant, waiting for the price to activate them. And once these massive orders start getting filled one after the other, they cause a massive movement in price, either up or down. We see this movement in the form of institutional candles. That still doesn't answer the question. This is the resistance key level. When the price comes to this level, it drops. It did that 1, 2, 3, 4, 5 times. So why not do that the same thing one more time? Well, at this key level, there's a large number of unfilled orders. This is what makes it a resistance area to begin with. Let's say there were 20,000 unfilled sell orders. Of course, we can never really know the exact amount of unfilled orders. That's why we call them hidden orders. But for the sake of simplicity, let's say 20,000. Okay, all 20K orders are placed. And the first move is coming. It starts filling up sell orders, triggering as many orders as possible in this move. Now we have successfully filled 2,000 orders. So we have 18,000 left. So we go through another cycle. A quick second touch that triggers 3,000 orders. Third touch, we spend more time hovering around this area executing more orders. We end up filling 10,000 orders. And another 2,000 right here in the fourth touch. We have only 3,000 unfilled orders left at this point. Then it triggered 2,000 more. We have only 1,000 unfilled orders left at this key level. Now tell me, do you think this will be enough to hold it? Maybe yes, for a couple of hours, but on a daily time frame, the price easily pierced into a new support area, creating an institutional candle in the process. And a huge number of retail traders would be left holding the bag. Some of you might be thinking, if we have two resistance levels that are so close to each other, well, we need to consider the higher key level, not the lower one. This is so obvious. Are you sure? Because it was staring at you the entire time. Is this a valid key level? We have 1, 2, or 3 touches to this resistance level. This is more than enough to deplete this area of all unfilled orders. Normally 1 or 2 touches is all it takes. In this situation, if we choose to short from up here, we set a very deep stop loss while taking everything into consideration. You will still get stopped out. The market will not respect a price that has been visited so many times before. So, of course, the result was a massive rally. We were 100% on the opposite side of the institutions. This is trading with absolutely no clue of what's going on in the market. To sum up, even the default case of support and resistance is not consistent because it doesn't give any valid answer to the biggest question of all. Is the amount of unfilled orders enough to hold each key level or not? If we wait for too long, we risk trading a low quality zone. And if we're in too early, well, we won't be able to detect key levels because they normally need at least 2 swing structures to be detected. Meanwhile, in supply and demand, we have automated rules to help us figure this out. For example, the zone needs to be both fresh and original. These are some of the most important supply and demand concepts that you need to know. And I think this is a good time for us to discuss them. First of all, let's look at a previous copper example from a supply and demand point of view. What do we see? Well, finding our supply zone is quite easy now, and it's a high quality one too. There are a couple of supply and demand rules that guarantee we find only high quality zones. Ideally, we want to trade the first touch. And our goal here is to make 3 Rs, a very realistic risk to reward ratio, and a very good probability of success. Alright, how can we spot these zones? Let's start with rule number 1, freshness. To detect freshness, we need to find zones that have not been tested, or at the very least not violated on the preferred version of our zone. This way, we filter out all the lower quality zones and we end up trading higher quality ones. Because now we know they have a larger number of unfilled orders ready to push the price in our desired direction. If you want to learn more about drawing the perfect preferred version for your zones, check out my supply and demand playlist. But let me walk you through it really quickly. In this example, this would be our preferred version. And what you immediately notice is that the first touch did not violate it, meaning it didn't enter the zone at all. It usually does, but in this case it didn't. So what does this mean? This zone is likely still fresh, even after the first touch. So what happens when the price comes back into this zone? We should expect to see a drop from here. And this is exactly what happens next. Now, we are right here. Take a look at the zone now. Is it still fresh? No, absolutely not. This zone is now violated, and per our rules, we should not trade it. We should look for a higher quality zone above it. And of course, when the price hits this key level, it will trigger all the remaining unfilled orders and rally past them. Then we have rule number 2, originality. To detect originality, we need to look at the left of our zone to see if it's an original move or not. Because if it's simply a reaction to a previous move, that could make the entire supply zone invalid. Originality probably needs a video on its own. Let me know in the comments if I should make a supply and demand video on originality and freshness. I do generally believe if you fully grasp both of these concepts, you will never need to look at the chart in terms of support and resistance anymore. Because using concepts like freshness, originality, and finding high quality zones in general, what these concepts do is practically make you able to predict the future. Meanwhile, if you are looking at the chart in terms of support and resistance, you will only notice the patterns emerging too late. You'll be among the last traders to get in on the action. Maybe this is just me, so feel free to take it with a grain of salt. But the way I see it, supply and demand is the theory of everything when it comes to technical analysis. And every other system out there is a derivative of this theory. Some are very good and some are just a special case of the original theory. Support and resistance is one of these special cases where we move inside a very specific horizontal range or channel for a prolonged period of time. And every zone would be tested 2, 3 or even 4 times to be considered a key level. And when breakouts happen, the levels need to seamlessly convert from a support level to a resistance level or vice versa. We call those flip zones. This is a special case that makes support and resistance a good TA method. But we have to understand, this is too perfect to be repeated consistently. And since it doesn't happen consistently, support and resistance fails to work consistently. And it doesn't happen in every asset out there either. This is a soybean chart, by the way. Again, another cyclical asset. I'm really trying to show you the best case scenario here for support and resistance. But no matter how we analyze it from different angles, there's a fundamental reason why it will never be consistent. So after this, if you still want to trade support and resistance, by all means, make your own journey happen. Because no matter which side we are on, the market always finds a way to teach us. Your love and support means a lot to me. I'll see you in the next one.